Howdy, hotshots. It's the Dividend Daddy, your favorite, not a financial advisor with not financial advice. It seems like the market is a little bit more bullish on ULTY. Now, we have talked about before how we can't really influence the price very much when it comes to ULTY because it is an open-end fund. So they create new shares and they destroy shares when they have inflows and outflows. But I have always said that we can change the premium or discount to NAV that we see slightly. We've seen it go down to about negative 0.2% for a discount to NAV, and right now it's at 0.14% premium to NAV. And so what that tells me is that there's more money coming in than there is going out. You wouldn't expect to see a discount to NAV if there's a bunch of new purchases happening throughout the days. So I saw that they've had over $250 million worth of inflows in the last week, creating more than 27 million shares during that time period. Now, we have talked about before how the size of ULTY doesn't really benefit us in ways that you might imagine. If you think that there's a bunch of inflows and so we're going to make a bunch of money from that inflow, I would say that that would be incorrect. Of course, I'm not an accountant, so take it with a grain of salt. But because they're creating new shares with that incoming money, it's not like it's getting piled into the shares that exist. It's not driving that market price up to get us gains. A lot of people think that they can influence the price of ULTY, or somebody out there is influencing the price of ULTY based on pumping up the market. You can't really do that, not directly anyway, because the NAV is derived from the internal holdings, the options that they hold, the cash that they hold, and the stocks that they hold. So typically what is going to increase the NAV is when they sell options and they get premium, or when they buy stocks and those stocks go up in value. But only to the point that their covered calls are sold, because that strike price is the limit of the gains that you're going to get on that stock, right? If you have a $50 stock and you sell a $55 call, then your gains are limited to the $5 between the 50 and the 55. Once it goes beyond that point, you're not going to realize any gains, because all of that gain will go to the options buyer who has all of the rights in this scenario. But it is good to see that the market is happy with ULTY's strategy. It's good to see that it's trading at a premium to NAV, because that means that there's more people interested in buying it, even if it is above what the NAV is. So that is good for us, at least psychologically, as ULTY holders. Now, I don't particularly care if the fund gets really large. It's nice to have it large enough that it has liquidity. It's nice to have it large enough that they have enough funds that they can make the moves that they want to make. But the bigger the fund is, the less nimble it is, the more holdings that they're going to have, which is good for diversification purposes, but you don't want them reaching for opportunities. You want them to take the opportunities as they're presented to them. So you don't want them just having to buy whatever they can buy in order to spend the money that they have incoming, right? So it's a two-edged sword. You want it big enough that it's liquid and that they have the money they need to do, but you don't want it so big that it's like this lumbering giant that can't make moves when they want to make moves, or makes moves so large that it actually influences the market on the underlying stocks, and you wind up not being able to move in and out at prices that are advantageous to you. So we're waiting to see today what ULTY's distribution rate will be. It looks to me like QQQI has made a declaration of dividend, a dividend declaration, and it's 60 cents this month, which annualizes to over 13%. And I would say that if you're looking to get into QQQI, I am, and so I bought some more shares this morning, and I'm just going to keep piling into QQQI until it is probably my largest ETF holding. Now, I'm still keeping my sizable holding in ULTY, but I want QQQI to be bigger just because of stability. So it's over a 13% yield annualized today, but that's a little bit lower than what we have seen in the past with QQQI. And so I would say that the volatility wasn't there enough to generate the premiums in the Qs as what you've seen. So I wouldn't expect ULTY to be able to generate a much higher distribution this week than it did last week either. So last week it was 9.26 cents. I would expect that we're still going to be in between the 9 and 10 cent range, hopefully a little higher than 9.26 cents, but I wouldn't expect us to break 10 cents this week. Now, it's possible. We did have the rate cut last week, it's funny because it seems to me, and maybe somebody who's even more skilled in options calculations can tell you, it seems to me that options get more volatility in their pricing when things are going down as they do when things are going up. And there's also a put skew. So puts are a little more expensive because people are buying them for insurance rather than just speculation. So puts have a little bit higher premium than calls do, the same distance from strike. And it seems to me like when things are rocky, people will pile into options more, and that increases the options volatility calculations, and so you can get more premium from them that way. So when things are going bad, it seems that options are paying more than when things are going good a lot of times. And since things have been going good the last few days with the rate cuts, I would expect that our options premiums would be a little bit lower. But of course, we've been seeing gains every day on ULTY, so it's offset. Our total return is looking pretty strong right now for the last couple weeks. So it isn't just options premium that we're concerned about. That is our major driver with ULTY, but overall return, total return is going to be what matters the most. QQQI is going to be more of a slower, steadier growth. I'm more comfortable with more money in QQQI, but I don't have it there yet. So today is a good day to do that because today is their ex-dividend date, and so it opened up 60 cents lower than what it closed at, and it was even down a little bit more than that. It was down like 66 cents when I was buying some of my shares. I made a couple purchases this morning, had to transfer some money around and get it over there where I could snag me some of that QQQI. So if you're looking to QQQI and chill, maybe look at it today. I can't tell you what to do, but I would much prefer purchasing a stock on ex-dividend date than purchasing it the day before and waiting for that distribution. And the reason that I say that is because of tax consequences. Now, if you're in an IRA or you're in you're in some sort of a tax deferred account, then it's not going to make a difference to you. But if you're holding it in a taxable account, then you could incur tax complications by buying the fund right before distribution rather than just waiting and getting a lower cost basis the next day. So I wanted to buy QQQI a couple days ago, and I did buy some shares, but I waited for the bulk of my purchase this week to buy it after its ex-dividend day so that I didn't get a distribution immediately after buying the shares. I'd much rather get the lower cost basis. That's just my own personal preference, but I do think that there's some benefit to that. Now, if you're only looking for income and you wanted the income right away, maybe somebody on here can explain why it would be beneficial to buy it before the distribution. If it had gone up overnight and then opened up less than the distribution had paid out, then maybe it would have been beneficial to buy it before the distribution. But this way it worked out for me. I was able to get a little bit better entry price on my QQQI, and I'm going to keep accumulating that fund. I have bought some Chippy in the last week. I did buy some WPay, so we're going to be watching that and looking at how that performs compared to, people are talking about WPay and they're comparing it to ULTY. To me, it's not really an ULTY type fund. It's more of a YMAX type fund, but I need to look into both of those more and see how they jive, because I think WPay, and I could be wrong, I just bought some a day or two ago and haven't really got to dig into it yet. I didn't buy very much of it. I just wanted to get it in my portfolio so it was easy for me to remember and to track. But I think that's a fund of funds for Roundhill. And that being said, you're paying management fees on top of management fees. So those are never going to be my favorite funds. I've got AIPI, I like that. I've got Chippy now, I like that. I did buy some SLJY, I like that. I have GDXY, I like that. I'm spreading the money around because I don't want to have all of it going down at once. I'd rather have a little bit of diversification so that they even each other out. So I've got my ULTY, I'm getting my QQQI, I'll probably build my SPY position as well. I'm gonna look at GPIQ, so pretty soon we're gonna be doing a comparison with GPIQ and QQQI, see which one we think is better. I think GPIQ leaves room for a little bit more growth and pays a little bit lower distribution. QQQI pays a bigger distribution and leaves less room for growth. So we're going to have to look at the total return of both of those compared to each other. But the difference in distribution is not that important to me. I know GPIQ was under 10% last I looked, and QQQI is over 13%. But I'm reinvesting my distributions right now anyway, so my position is going to grow in either one of those. I just have to see which one is going to grow it faster. I did tell you yesterday, if you saw, not very many people watched the video, but I did tell you what I was doing yesterday with Big Bear AI. They had a dollar, they gapped up yesterday and they were up $1. So I was able to snag some put premium on that for an annual. If you annualized my return, it would be over 300%, almost 400%. So I felt like that was worthwhile. I did not take a big position in that. I just sold one contract. So you know, if I get stuck with the Big Bear AI, then I'll just be moving that into a wheel. And for those of you that don't know, a wheel is what I've been doing with Lumen. It's what I've been doing with Innoviz. It's what I've been doing with Disney. I did sell a Disney call today. I'm a little bit underwater in my Disney position, but they've got some bad news coming out about their attendance at Disney World. And so I was able to get just a little bit of premium. I think it was 63 cents on a 125 call, which is above my cost basis. And I said, you know what? I don't think it's going to go up from here very quickly. Could be wrong, but I'm going to go ahead and get the $63 while I can, just to continuously chip away at my Disney position. Get that lower cost basis every time I sell a call. So every time it gets close to 125, I sell a 125 or a 130 call, and I'm just getting a little bit of income off of that because it's been kind of languishing for me for a handful of years here. I've gotten in and out of Disney a couple times, but I wind up stuck with it for a year at a time every time I get in it. So I just generate call premium that way. I normally enter it with a put position, and it pays a little bit of a dividend, not very much, maybe like 1%. So I have a couple shares, over 100 shares. I think I have like 102.5 shares or something, just because over the years I've gotten dividends and reinvested them. So if I lose my 100 shares of Disney, what I'll do is I'll wait till it moves back down into probably the 100 to 105 range and then sell a put. But I don't anticipate losing that position because I don't think it's going to go up over. My expiration date is October 31st. I don't really think it's going to be up above $125 by then, and so I don't anticipate losing it. But if I do, I will move that money into probably QQQI, and then I'll be getting a much healthier distribution on that than I've ever gotten out of Disney. And if Disney goes down, I'll just move more money back in so that I can sell another put. Target is still languishing. I don't know exactly the problems that they've been having. It is kind of a discount retail chain, and it's very popular. So I anticipate that they're going to stick around. So even though I'm underwater in that position by like 20%, I'm just going to hang out and get the distributions from that, which I think are close to 5%. So I'll just keep reinvesting those, lowering my cost basis on Target. And then when it gets back up to where I can sell a call on it, I'll be selling a call on that and generating income from that. But right now it's too far away from my cost basis to generate any income and guarantee that I'm going to get out of that position whole. Since I don't think it's going to go away, I'll just hold on to it. If it goes down further, I might start adding to that position to cost average down, because I really just, everybody likes Target. I know Walmart's been doing better and trades at a higher P to E because people see Walmart as more of a growth company than Target is. But we buy all our groceries at Target, and we order stuff online from Target all the time. When I go in their stores, they're generally pretty nice. It's a pleasant place to shop. So I don't really foresee them going out of business. But anything can happen. Luckily, I'm getting a pretty good dividend on that right now. It's not as good as one of these high yield funds, but it is decent. So I don't mind holding on to it. Smith & Wesson, I'm underwater in that, but it's got a pretty good dividend as well. So I'm just reinvesting my dividends on Smith & Wesson and increasing my holdings of Smith & Wesson so that eventually when it does come back, if it comes back, I'll be able to get whole on that position too. And a lot of these stocks that I have that are higher dividend stocks that I've been kind of trying to wheel on, they haven't performed as well for me as these covered call ETFs. So as I get out of those positions, I'll be doing less and less of those positions and putting more and more into various covered call ETFs. That's going to be my main investment strategy going forward. But I will still be investing when I see very high premiums on individual companies. I will still be selling puts and covered calls on those as well to generate income. So my main priority right now, although it probably should be growth, is income, because I like using that income to buy more shares of whatever it is I'm working with, which does still grow my account, just perhaps not as fast as some of the growth funds would. But you never know the future, and I like having that money right now getting paid out so that I can buy more. And to me, that adds a little bit of security in my mind, because I'm getting the income as I go instead of just waiting to sell it. A lot of times I'll ride something up and then it'll just come back down, and I thought it was going to keep growing, and it didn't. And so when I'm getting income as I go, I know I'm making that return month in and month out, or week in and week out in the case of ULTY. All right, DGen, so that's what I'm doing today. I wanted to tell you about QQQI and the possibility of adding to a position that you might have today because of the distribution, bringing that cost of those shares down. And I'm kind of anxiously anticipating and waiting for what ULTY's distribution is going to be this week. Let's hope it's a big one. I'll talk to you guys later.